25th is right. Oh, you just got in just a couple days ago. Okay, that's interesting. And the morning-ish, probably down here. And was that the May 17? No, the June 21. Good for you. Good job. June 21, and that would have been the 197.5. So down here for 60 cents. So your break even is 99.40. So there we go. Change the color to a little bit more solid since it's active. That's your trade. That's looking good. Now I can see why you're up 30%. Now, I wonder if you should have even taken the gains because one, two, three, 30% return on capital in 3 days, 30% to max profit on your return on capital in 3 days, $60 on a, what was it? $2.50 spread is $60 divided by 190. Does that make sense? Did you follow that, Randy? Who was able to follow that? Say I with a little I. It's a $2.50 spread. You got 60 cents. It paid 60 cents. So that's $60. The spread is $250 collateral. So therefore it's $60 for $190 collateral. See, there is a shitload of stuff baked into everything that I just said. Yeah, definitely too fast. So I'm glad you said that. Do you get it now? Do you understand now, everybody? $60 you could make if you put up 190 bucks. Okay, now you understand. Yeah. So that's 31.5% return. See, I'm seeing that here. 31.5% return. Okay, now here's look at my, can you see my little here? I'll move it over here. See my calculator, okay? But now what you could do is you put a parentheses around the 60 bucks. You didn't make the full 60 bucks, you made 30%. So you go times 0.3. So you made 30% of the 60 bucks. You don't have to worry about what that is. Let's say it's 31%, it's some weird number, okay? And you can't do it in your head. Obviously 33% would be 20 bucks, but it's 19 something or whatever. But because it's still divided by 190, that tells you how much actual return, not max profit, because you're 30% to max profit, but your $60 divided by 190, your return on capital, should the trade work out all the way to 100% max profit, is 31.5% ROC. Okay, you guys minds are going to be blowing here because you got to keep all these numbers in your head. In other words, the trade itself could make 31.5% return on capital when you put it on 60 bucks for $190 for every $190 you put up. 31.5%. That represents 100% of what you could make. It's called max profit. All right. You're currently up, let's call it 31% to max profit. So like how much is that? We don't know. It's $18.6 out of the 60 times the number of contracts you have. If you have 10 contracts, it's 186 bucks, whatever. So we take the 1860 and divide it by the $190 that you put up, and we get you're up 9.7% on your capital. 9.7% on your capital. So did you follow that? And so that's it. Like, we could stop there or we could keep going. The interesting thing is that if you're up 9.7% on your capital in 3 days, that's insane. So now this you might have to take notes on in order to do this, but if you take the square root of the third 1/3 power, if you put that to the power of 1/3, it'll reverse compound it back down to 1 day's gain. So in other words, if you put something to the power of, let's say you have a gain of 10% on your capital, that number in itself is 1.1. That's 10% gain on your capital, 1.1. If you put that to the power of 2, if you got 10% for 2 days in a row, and you put that to the power of 2, then it compounds it for 2 days. It does 1.1 times 1.1 because 10% on 1 is 1.1 and 10% on 1.1 is something more, like 1.21 or something. Probably is exactly that. I'm not sure. But the point is, by just putting it to the power of a number, it compounds the return for you mathematically. So I'm just giving you like shorthand math here, like the kind of math you should have been taught in school, not here's how you do like logical thinking, practical thinking math. Using powerful math, complex, but logical and practical, right? So if you want that to compound for 2 days, you do to the power of two. You take the return and put it to the power of two. But what if that was your return for a week, the number 1.1, and you put it to the power of two? Does that mean it's for 2 days? No, it's for 2 weeks. That would give you how much that return projects out for 2 weeks. So it just, you have to keep in mind what you're compounding. Is it per day? Is it per week? Is it a monthly figure? Whatever. Okay. So if it was a weekly figure and you compound that 52 times, you get your annualized return on that kind of a gain. The performance that you're getting on your portfolio for subjecting your capital to that kind of return in 3 days or whatever it is, and you compound that out to a year, you'll get the annualized return. So check this out. So if you think of it in reverse, if you wanted to get 3 days of compounding gains, you raise to the third power, then if you'd like to know at 3 days, if this is the gain you're at, how much is that per day, reverse compounding back down to a single day unit? Then you just do one to the power of one over the number of days. It's just a fraction. It's the inverse. The inverse compact compounds it back down to the single, it divides it into 3 days of reverse compounding, sucking it back down to the original amount of gain per the single unit of one day. Okay. So I think that makes sense. So here we have, you did 9.789% return, for example, at 31% max profit on your capital. Now, what you got to do though is you got to add one to that, so that if you're going to compound it, it has to have a one in it. So that way it represents 109%, 0.789, right? 109. Now, if I said, okay, how much is that in 2 days? If I kept getting that every day, in 2 days, that'd be 20.5%. It starts compounding out. You have to have that one on there. It's important to just put the one on there. I can explain that right now. That's just kind of like mechanics of it. You would find out for yourself that things were fucked up if you didn't put a one, because if now you're at 0.978 and then you do that to the power of two, you're going to get a smaller number, 0.0095. You're like, wait a minute, what? I thought if I made 9% per day in 2 days, I'd make more. That's because you compounded the number without the one in front of it. So it needs to be like 1.1. And it's not. So you have to add the one in there as a matter of just bookkeeping, good bookkeeping on your gain. So now you have the number 1.09789. Now, if I take that to the power of two, now I've got a 20.5% gain in 2 days. But this wasn't in 2 days. This gained 9.7%, which comes from the 31% max profit of $60, is across 3 days. And I want to know how much is that per day. And what I'm telling you is you can put that to the power of one over the number of days, which is 3. And that will reverse compound it back down to its per day gain that it's been compounding to get to this point. So it's an average, and it's 1.03. So in other words, 3% gains per day compounded for 3 days will equal almost 10%. It was 9.7%, right? But here's the really cool thing is, now that you know what you're getting per day, we can go and we can say, how many days am I staying in this trade? And you can say, okay, until expiration, was 57 days. I'm supposed to be in this trade for 57 days. I mean, that's the option you bought, right? And to get to 100% max profit, which is 60 bucks on $190, I'd have to wait theoretically the whole 57 days, theoretically. And in that time, in 57 days, if I achieve that $60 out of 190, that is 31.5% return. Remember, we did that math earlier. I'm not just coming up with that number anywhere. Do you remember? $60 for 190 bucks in the end will be 31.5% return on your capital. Okay. Now, 31.5% return on your capital. Now, in just 3 days out of 57, you've achieved a third of that, as it turns out. You've achieved a third of that in 3 days. In other words, 54 days left to make the rest. But in 3 days, you did a third. So 54 days is the rest. So the question is, in 57 days, if you kept up this rate of return that you've been getting for the last 3 days, if you were to close out this profit now and nail it down and say, I love these returns, now let me go put this money somewhere else and get the same thing again, how much would you have made in 57 days if you kept getting this same return every day for the next 57 days? In other words, at this point, what kind of performance improvement are you getting? If you set it up to make 31.5% gains in 57 days, but in 3 days you're now up almost 10%, how much more than 31.5% in 57 days is that? Does that project out to be? And if it's a big number, you should probably close that trade out and take that profit and relocate it. Let's see. So we take that we reduced down to a single day. We take that number because now we hold the power of a single day's return, which is 3.16%. We've reduced it, recompounded it back down to a single unit of a day. And now we raise that to the power of 57 days. And you have to subtract one when you're doing percentages. You get 490% returns. So in other words, you're getting 490% return instead of 31.5% right now. So you absolutely have accelerated gains going on. And you should close that trade out. I mean, it's like this can happen the next day. If you get in, it can happen the same day. If you get into something and you get in for 50 days, our average um, goal is 45 days to expiration, right? 30 to 60, somewhere in there, erring on the long side. 45 days to expiration. If the if in one day or even the same day that you get in, the stock performs super well and you're up 25% to max profit. So you're 25% of the way to your goal in one day out of 45 days. Like just logically, first of all, don't you understand that that's way better than what you were supposed to get? Because like if you got 25% return every day for the next 45 days, you could retire a billionaire, right? I mean, that's subjecting your money to incredible gains. What's more important to realize is that the next day is likely not to be better. And so what that means is that if you hold the next day, now you're not getting as good of a return on your money in the long run as you did the day before if you closed it out. Kind of weird. You could make more money that next day, but it would, let's say, be a smaller amount, which is more likely. And now the average return daily that you subject your money to in your account has gone down, and that's not good. And so anytime you have a good profit in a single day or after a couple of days on a trade, it's more important for you to just close it and take it and flatline your account and wait to put it on something else that could do the same than it is to hold on for another little bit more gains, because what you're doing is you're stunting your annualized performance of how you put your capital to work when you don't close accelerated gains. So anyway, by the way, the annualized return of that one 3% per day is probably off the charts. It wouldn't even compute. I mean, getting 489% in 57 days works out to in 1 year. Well, it's not that big. It's 86,000% return per year. I mean, sometimes the returns we get, the accelerated gains we get, are so big. There's like, it's a bigger number than number of stars in the universe. It's it's off the scale sometimes. You absolutely should take you absolutely should take the profit on that probably. You know, but not if like not if it's you you should be an intraday trader about it. Like you should press your wisdom of the way things move to its edge. Don't just be like, all right, then I'm taking it now. Watch it. Like, what is this now? Micron. Like, look at the chart on Micron. Notice it's in an uptrend. High, low, higher low, higher high. Let it keep doing that until some point in which are ready. You can get out now. I mean, it's obviously, the interesting philosophical thing to realize is that the highest point that you get out in your portfolio will always be the highest point in your portfolio. So if you think of it less of, I need to ride this fucking stock to the tippy top, and more of, I simply need to allocate my capital in my portfolio into magical things, magical fairies that make it go up. And every time it goes up, I just move it over to something else that's an opportunity because that one thing worked out. I just move it to another thing. Every time, if you stop thinking about it as stocks and more like how your portfolio is performing and how you're managing your portfolio, then any gain is a good gain. Getting out at any point is the highest point in your portfolio. Any point you get out in your portfolio, when your portfolio is up, your portfolio has achieved the tippy top. You could never be wrong. And that's why just go ahead and taking the gains is, never wrong. And even if price goes back on you and you go ahead and take the gains and you are up still, you're still up. You're working your portfolio. Don't sweat not getting the tippy top on a stock. Be happy that the stock moved up. It doesn't matter where you get out at that point. It worked. Right? And now you got to move on and go again. You got to think of it more as about managing your money than anything else. Oh my God. You didn't record this? Oh boy, you really forgot that one day. Yeah, this was a master class. Maybe I'll cut that out and I'll post it on YouTube in a little bit, okay? All right, you guys.